Hi guys, I have part 2 of our value investing series. This is based on the book by Ben Graham, which is called Intelligent Investor. Warren Buffett, one of the most prolific investors in the world, swears by this book. If you've liked our previous videos and you would like to get updated whenever our investing videos come out, you can please click the subscribe button, or you can like or share our videos to know more and help people understand more about investments. The fourth strategy laid down in the Intelligent Investor is price to earnings ratio. And the fifth strategy is change in earnings per share. Now, these two are correlated, so listen to this very carefully. Price to earnings ratio talks about that how much money are you paying for 1 rupee of earnings by the company. What that means is that if a company makes $1 in profitability, how many times more are you paying to buy that particular stock? I'll explain this via the help of an example of one of our supermarket chains, which is across the country, called DMart. The parent company of DMart is called Avenue Supermart, and the promoter is Radhakrishna Dawani. Radhakrishna Dawani is one of India's most prolific investors. When he came out with its IPO, for every $1 of profitability of DMart, we had to pay 30 plus times to buy its share. So that meant that when the shares went on sale for $300 or $299, the profitability was very, very minuscule. Now, over a period of a year, investors saw the growth potential of DMart, and they started buying the share, and the prices of the shares of DMart increased exponentially. It went up to $1,200 to $1,500. However, the earnings did not go up by 4x or 5x. They were seeing a steady growth. What that meant is investors were paying a premium to buy a share of DMart. Another way of explaining this is, if the PE ratio of a company, the price to earnings ratio of a company is 30, and a company earns $1 every year, it will take 30 years for the investor to break even on its investment. So it's a very long process. So Ben Graham says, look for companies which have low PE ratio, so that the fundamentals of the business remain strong and you can recover your money as fast as possible. The fifth principle which Ben Graham has laid down is earnings growth. And this is very, very in sync with the price to earnings ratio. To calculate your price to earnings ratio, what you need to do is divide the price of the share by the earnings of the share. So the current market price of the share, divide that with EPS, the earnings per share. But by using this formula, you will come to know a past ratio. To predict the future ratio, if the company is in a growth stage, Ben Graham says that you should always account for future growth of the company. So what that means is that if, according to the earnings today and the price today, the PE ratio is 30x, the formula has not accounted for growth. You should either increase the growth of the share by 1/3 at the least if the company is in the growth stage, so that you can get a correct PE ratio, looking at the fact that the company will increase earnings over a period of time, the company will increase profitability over a period of time. So this is how earnings growth and price to earnings ratio is interrelated. The sixth investment strategy laid down by Ben Graham talks about the price to book ratio. What price to book ratio would highlight here is that if you sell the total assets of the company and you subtract the total liabilities, what would you be left with today? You compare that with the price to be paid. For example, if the total assets are $100 and the total liability is 80 rupees, you are left with 20 rupees. However, if you're paying $1,000, if you're paying 1,000 rupees for the same share, that means you're technically paying you're paying a premium 50x. Again, Ben Graham says that you should, according to the principles of value investing, you should not exceed this by more than 1.5x. What that means is you should not pay more than 30 rupees. If the company goes bankrupt today, at least you can recoup the money back as being prudent shareholders. So this is what the sixth value investing rule by Ben Graham speaks about, the price to book ratio. The seventh principle Ben Graham highlights in his principles of value investing is check if the company has a dividend record. If the company has a solid dividend record, what that means is that if the company is paying you cash as in when it grows, it's crucial for a company to understand its shareholders need to be rewarded for the high risks they take. And since value investing It's a very long-term process. You're sitting on shares and you park your capital. Then the price of the share starts increasing over a period of time. You should be rewarded year on year. And Ben Graham says that it's absolutely necessary for a company to be fair to its shareholders and pay them back. The more a company pays its shareholders in form of dividend, it shows the best practices for a business and the fact that the company actually cares for its shareholders. So this is one of the most beautiful principles which Ben Graham has highlighted. There's also a small note Ben Graham talks about is a margin of safety. He says that never overpay for the stock, however exciting it seems. Even if you think you can make 2x, 3x, you should do your research properly, and only then you should go and invest it if it fits into these 7 principles. Again, this book is recommended by hundreds and thousands of people across the world. It's called The Intelligent Investor. It's a red paperback book. If you would like to have a look at it, go and buy it at any store. Have a look. It's an exhaustive book, but it clearly defines, if you're starting out, what you need to do as value investing. You can always add more inputs of your own when you're investing. I have my own inputs when I invest, and it gives me a very nice boost when I'm trying to understand which stock to pick and which stock to not pick. It's very necessary for you to let go of opportunities, for that one opportunity to come by which gives you a 6x, 10x return over years. So wait for it, it will come. Be patient when you're investing, and as the term value investing says, seek value in any stock and it will give you exponential return over the years. So I hope you've enjoyed our value investing series. I'm going to keep making more videos for you guys to understand investments. As a Bachelor's of Financial Markets student, I didn't get the best knowledge about how to practically invest. These rules will help you go from 0 to 1 or 0 to 2 in investing and hopefully get you started. If you have any questions, please leave them in the comment box and we'd love to get back to you.